All right, here we are again. So we've got a couple of, well, we're going to start chapter 3. I think we already started it, but we'll finish it up tonight, and then we'll dive into 4. So 3 is a discussion about interest rates, and 4 is where we start to introduce the Federal Reserve System, which is ultimately responsible for setting the level of interest rates in the U.S. economy. So it's a natural tie-in. So, all right, let's get back to where we were in chapter 3. And here we're looking at the structure of interest rates. Now, of course, the whole point of this chapter is that there's many different kinds of interest rates in the economy. There isn't just a single interest rate, as you obviously know, but what we want to understand is what is driving the differences between them. All right, so at any given time, there's an array of different interest rates available to investors in the marketplace from various securities, and ultimately, the differences will, as we'll see, will come down to a few key factors. One of them would be the time over which a loan is being made. And number 2 is typically credit risk. Okay, those are really the 2 primary differences between interest rates that we see throughout the economy, the time and the credit rating. So I think we already looked at the yield curve for the US Treasury Department. Let's look at it again and see what it looks like today. Oh, that's not, is that what I wanted? Nope, that's a different website. All right, hold on. All right, here we go. So today is the 15th. So if you look, like I was saying before, in the Treasury market, you have a large number of different maturities to choose from, ranging from 1 month up to 30 years. That's kind of unusual. Most borrowers only offer typically a small number of maturities. And in fact, almost all corporate bonds that trade in the United States have a 30-year maturity. They don't have to. There's no law that says they have to be 30 years, but investors apparently find that to be very convenient. So the practice has been to sell 30-year bonds for corporations. Some government agencies have bonds that might be a little longer than that. Sometimes you do run into 40-year bonds, but they're typically government agencies like the Tennessee Valley Authority, for example. Normally, though, government bonds range from 1 month to 30 years. And there's others as well, but primarily this is what you would see in the market. Now, in the Treasury market, what really distinguishes this from the rest is that this one is considered to be free of credit risk. The thinking is that the government is not going to run out of money. Even if they do, they can raise taxes, a luxury that corporations just don't have. So the chances of the government saying to you, listen, we know we owe you money, but we just don't have it, are pretty low. For all practical purposes, 0. And so because of that, they can get away with paying preposterously low rates of interest compared to other borrowers in the economy, because people trust them. They believe that they'll get their money when it's been promised. And so they have the ultimate credit rating that, the rest of us can only dream about. In other words, their credit rating is essentially perfect. And so that's why investors are willing to lend them their money at such low rates of interest, certainly lower than you would get with other securities in the marketplace. I don't think there's a website that shows you what kind of yields corporate bonds are issuing, but we can look up individual corporate bond yields just as a point of comparison. Like, for example, let's go to this website, FINRA. All right, let's just randomly pick Apple bonds and see if we can look up some of their numbers right now. Oh boy, here's bond data. I find this website to be very awkward to negotiate. It's not as clear as market activity, maybe, search. Let's try Apple. Oh, let's sign the old user agreement. All right, so here we go. Now, if you notice, these are the yields from these different bonds issued by Apple. Now, they don't appear to be listed in any particular order, which is kind of unusual. But let me just pick this one at random. We'll click it on and take a look at some of the details. And you'll see that the maturity date is May 4th, 2043. And that means 22 years in the future. Most likely, this was issued in 2013 as a 30-year bond. And now, of course, 8 years have elapsed, so it's now a 22-year bond. The coupon rate was 3.85%, which means every year the interest you're getting is 3.85% of the face value. Most likely, the face value is $1,000. So that would mean every year, the interest that this bond is generating for you is $38.50. All right, now that doesn't sound like a lot, but it's more than you would get with a treasury bond. Remember, we said here, right now, as of today, that 30-year treasury bond is paying 2.2%, and here we're getting 3.85%. So why is it higher? Because Apple, even though it's a great company, it's still a private corporation. There's always a remote chance that it could go out of business before you get all your cash flows. So you have to be compensated for that risk with a slightly higher coupon. And so now, by the way, the bond has since gone up in value, 117.09. It's selling for about 17% higher than the face value when it was first issued. And that's primarily because rates have dropped in the meantime. So the actual yield, if you bought that bond right now, your yield is not going to be 3.85%, but only 2.8%, because you bought it at a time when its price was very high. But even that 2.8% is more than you're getting in the treasury market, where they're only paying a yield of 2.2%. So even, and by the way, somewhere down here, there's a credit rating listing. According to Standard & Poor's, Apple is AA+, which is one below the top rating, which is AAA. Okay, so they're just a little under the top possible rating. And so because of that, they're forced to offer us a slightly higher yield than you could get in the treasury market. If I found another company that's not doing terribly well, let's see, who should I choose? Let's think of a company that's not doing terribly well these days. How about let's see. I would imagine any restaurant chain would be in trouble right now. Like, for example, TGI Friday. I don't know if they've got that in here. No, okay. That's probably not the right name anyway. What else could go in here? Chipotle, how about them? Nope. Oh boy. They must belong to somebody else. Man, I can't think of any other companies that might not be doing very well right now. All right, well, let's just randomly pick another company. How about Coca-Cola? I'm sure they're doing fine, but maybe not as well as Apple. Now, yeah, they probably are. Now, here's one. This one has a due date of 2027, which means it was probably issued in 1997 as a 30-year bond. And it's selling for 111.51, which means the price has gone up 11.51% since it was first issued, primarily because rates have dropped since that day. And their credit rating is A+, so they're a little bit below Apple. Apple's AA+, Coke is only A+. So their yield Well, it says here 0.906, but I think what's happening here is that this bond is callable, which means that the company can buy it back at any time it chooses. And that's probably why the yield is so low. So let me choose a different one. Okay, how about this one? This one is not callable. So this one, oh my God, it matures in 2093. Wow, that's a little bit of a surprise. When did it? I wonder when they issued that. Um, Man, even if they issued it today, that's 72 years in the future. You don't see that very often. Like I said, most corporate bonds go out 30 years, and that's about it. But if you notice, the coupon is huge, and the yield, although the yield is only 3.707%, that's because the price is very high right now. It's the only way this can actually have happened is this bond was probably issued. It's possible that it was issued as a 100-year bond in 1993 when rates were quite a bit higher than they are now. And that would explain why the price is so high and the yield is as low as it is. But still, remember, you're only getting 2.2% in the treasury market as opposed to 3.707. And Coke is rated at, like I said, at A plus. So it's still very safe, although not quite as safe as Apple, and certainly not quite as safe as the treasury market. Anyway, so I just wanted you to see that, all these bonds trading out there, and even within the same company, Coca-Cola, the yields are all over the place if you look at this list. But that's because these bonds were issued at very different points in time. Okay, some of these could have been issued 20 years ago. Some of these could have been issued last year. So for the same bond, you can have many different yields depending on when they were issued. But you notice consistently their ratings are A plus, which is good, but not perfect. So there's all kinds of different bonds, as we've seen, trading in the marketplace because there's so many issuers. There are foreign bonds, there are municipal bonds, there are corporate bonds, there are treasury bonds. There's so many different kinds of bonds out there, and every single one of them has a different yield. So the question is why? What is separating these from each other? Why do you see all these different bonds with different yields on them? So again, the two primary explanatory factors are when does it mature and how much credit risk is there? The higher the credit risk, of course, the higher will be the yield on the bond. Otherwise, nobody would buy it. Okay. Now, I'm sure there's some companies that are really in rough shape where the yields are even higher than this. I don't know. Let's try Citibank or Citicorp. Now, there's only one. What's going on with this? Oh my God. All right, let's not use Citicorp. How about Chase? JP Morgan Chase. Now they're at A minus, and this one appears triple B minus, which means they're not as safe as Coca-Cola. The yields are a little bit higher. They're not as much as I might have expected. This bond, for whatever reason, is rated triple B minus, which is quite risky. And as a result, the yield is 3.646. It must contain some provisions that increase the risk. And did you notice there's a little bit of a typo here? The maturity date is listed as 39.99. Wow, that's an optimist who buys that bond, let me tell you. Okay. No. I don't know what they meant, but it's not obviously 3999. But anyway, all right, so let's go back to the notes. So interest rates are a function of several important factors. The most important are maturity and risk, by which I mean specifically credit risk. But also we have to think about liquidity and tax treatments because not all bonds are taxed at the same rate. Treasuries are not taxed by the federal government. Actually, I'm sorry, they are, but they're not taxed by state and local governments. And liquidity, of course, means the ability to sell the bond in a hurry. And treasuries are very liquid, but many corporate bonds are not very liquid at all. If you needed to sell it, it might take a while, and you might actually have to accept a small loss in order to sell the bond. So, in other words, anything that makes a bond more attractive is going to lower the interest rate that it pays. And anything that makes it less attractive will increase the interest rate that it has to pay in order for investors to buy it. All right, so this is a table I put together a while back. You can see it's not radically different than what we're seeing today. But the point of it is that for the most part, except maybe here, as the maturity grows, the yield tends to grow with it. And throughout US history, most of the time, this graph, which is called the yield curve, has had this distinctive upwards sloping shape. It kind of rises and then it tends to flatten out a little bit. Sometimes you see other shapes. Sometimes the curve can get a little steeper, or it can get a little flatter. Sometimes it can have strange shapes, though, depending on what's going on in the market. Like a while back during the credit crisis, we tended to see this kind of thing. It was very strange. There was a small hump in it, and then it flattened out, which this was what we saw during the credit crisis. This is normal. But then occasionally, very, very occasionally, although this happens very infrequently, the curve actually can slope downwards. You almost never see that, but it is not impossible either. Something like that. Now, normally when this happens, one of two things is happening. Typically, inflation is very high, or that means a major recession is imminent. In other words, this is bad news. You don't like this one. It's like when the sky gets really gray just before it rains like crazy. It's kind of like the same idea. You don't want to see that. Okay. Now, but having said that, the most common shape that we typically see, like I said, is something like this. Now, why would that be? It indicates that for whatever reason, these bonds are considered to be riskier, even though these were all issued by the Treasury Department, let's say. Even within the Treasury yield curve, the bonds at the long end, 30 years, let's say, are considered to be riskier than the ones down here, let's say at 1 month. Why is that? What's going on there? Okay, well, number one, changes in market conditions will have a greater impact on the prices of longer maturity bonds than shorter maturity bonds. Now, why is that? Because a longer maturity bond has more cash flows and they take place further in the future. So in other words, imagine you're comparing a 30-year bond, treasury bond, with a 1 month treasury bill. Now, remember, 1 month treasury bill will mature in a month. You'll get your money back in a month. No matter what happens in the market, there's a limit to how much impact there can be in the price of this 1 month treasury bill because it's going to mature in a month. With a 30-year treasury bond, you don't know what's going to happen in the next 30 years. So because there's a longer time frame involved and there's more cash flows to be affected by any changes in the market, it stands to reason that the 30-year bond is riskier or more uncertain than the 1 month treasury bill. And that's why the yield is so much higher for 30 years than for 1 month. Now, if you notice, these are quite low. We have to go all the way out to 7 years to even reach 1%. But then once we get here, it starts to rise fairly quickly because these are the bonds that are considered to be relatively risky given how far in the future the cash flows take place. It's almost like the difference between lending your friend money for a month versus a year. In other words, suppose let's say you work at a job and you lend your coworker $100, and let's say the loan is for a week, versus another coworker that you lent the money for 5 years. In which case are you more likely to get your money back, do you think? I'd go with the 1 week because not much can change in a week. You wouldn't have lent this guy the money in the first place if he was unemployed or something like that. But 5 years, who knows? Anything can happen in 5 years. So risk is greater for these longer maturity securities. And therefore, the yields have to reflect that. All right. Now, when things are looking up, and the economy appears to be heading for a very rapid expansion, there's a tendency for the curve to get steeper. So not only is it upward sloping, but it's getting steeper. Let's say from here to here. So let's say we were here, original curve, and all of a sudden there's evidence all over the place that the economy is growing quickly. The curve will start to shift up because when the economy heats up, there'll be more demand for borrowing by investors, by consumers, by businesses. And so that will tend to push up interest rates. So the fact that the yield curve is steepening is an indication that the economy is expected to accelerate in the near future. In other words, people are optimistic. But if the economy is dragging along, you might see the opposite. The curve might just shift down from here, let's say, to here. The economy is expected to weaken, just because things haven't been going well lately. And then sometimes the entire curve can shift up or down, not just getting steeper. This would be a sign that we expect higher inflation in the future, or it could be. There's other explanations, but let's just say here investors expect higher inflation. This is the original curve. And so that would tend to cause this curve to shift up. All right. Now, interestingly enough, just as an aside, throughout history, Okay, throughout history, there have been periods where international markets were in turmoil and investors sold risky assets and used the proceeds to buy US Treasury securities. This is known as a flight to quality. And the net effect is to cause US rates to fall. Okay, so let's see why. And you do see this every so often. When there's a crisis, an international crisis, people get worried, they get nervous. They'll sell off the existing bonds that they have and replace them with US Treasuries. So what happens here is that if investors buy more US Treasuries, their prices rise, which causes their yields to fall because the coupon rates don't change. In other words, because the coupon rate is fixed in advance. If you have to pay more to buy a treasury with a fixed coupon, the yield will go down, and so the entire curve will shift down. Okay, so this is the curve with international crisis, or which we mean as a flight to quality. So everyone parks their money in the United States, and before you know it, treasury yields are dropping like crazy. Once the crisis is over, then the situation will reverse itself. Okay. All right. Now, default risk. What is default risk? Well, we've already briefly alluded to this. This is the risk that not all the payments will be received in a timely manner. This is true for any security, not just bonds. Now, with issuers of bonds, they're obligated to make interest payments every year, and at some point in the future, they have to refund the amount you invested with them. So if the face value is $1,000, that means at some point you have to be repaid your $1,000. In the meantime, you have to get interest every year. Default risk is the chance that this never happens. Even if the issuer only misses a coupon, or if they're only late, they're technically in default. So the risk of this happening is known as default risk, and we can see that those Standard & Poor's and Moody's ratings are designed to help us understand how likely that is to happen. Now, I think I may have already mentioned this. With the Standard & Poor's ratings, let me just quickly review if I haven't already done this. What kind of ratings do they have? Well, the best is AAA, AAA, AA plus, AA, AA minus, A plus, A minus. Then we get into the scary territory. Well, not really. Triple B plus, triple B, and triple B minus. All of these are collectively known as investment grade bonds. And then, we fall below the threshold to some very scary territory. It goes down a ways. I think maybe triple C is a double C, maybe is as low as it gets. Once you get down to this neighborhood, this is big time trouble. And then it goes down. I think there's a D down there as well if it's already in default. So these are collectively known as investment grade bonds. And these guys are known as either speculative bonds, or sometimes they're called junk bonds. Now, junk is kind of a relative word, I suppose, but that's the name that they came up with on Wall Street. These are the ones where there's a pretty decent chance you won't get all your interest payments. But if you do, you can do very well. In fact, some hedge funds, this is exactly how they make their money, by investing in these very low rated bonds, but choosing the ones that are least likely to default. In fact, studies have shown that the extra yield you can earn by owning these bonds is more than enough to compensate for the actual risk that they contain. In other words, the default experience has been a lot less than you would think based on these credit ratings. Now, you and I should not be speculating on junk bonds, but people who do this for a living can often do very well because the bonds tend not to default. It's actually a fairly rare experience. It doesn't happen very often. In fact, I wonder if there's any statistics out there. Hold on a second. Now, here there's an article about how they went up during the COVID, of course. Well, what would you expect? But I was just wondering if we could get some sense of what kind of numbers. Oh, here we go. So in other words, they're saying 6.2% is triple what it normally is, which implies that, we're looking at roughly 2% is a normal default probability. Yeah. Oh, here we go. So you can see that during crises, it jumps up quite a bit. And so, when things are good, the default probabilities are quite low. And the long run average is around 3. And now it's spiking up because of the COVID. But just before that, it was actually quite low. Well below average, except for this little peak here for some reason. And, these gray bars indicate some kind of financial crisis. So, so default historically the percentage has been very, very small. All right. Well, anyway, so sovereign risk. This is something that's unique to foreign governments. A sovereign country, of course, is an independent country, and so the risk that a sovereign government will default on its debts is called sovereign risk. Now, this happens very occasionally. Governments that are heavily indebted can run out of money. It happens. Not the United States, of course, but countries that have way too much debt have occasionally in the past defaulted on their debts. One example of this is Argentina in 2001. They simply ran out of money. So if a U.S. corporate bond defaults, there's a procedure that's followed. The corporation is declared to be bankrupt, and their debts are hopefully restructured so that the company can survive. If not, then their doors are closed forever. But you can't declare a sovereign government to be you can't call a country bankrupt and sell off its assets like you can with a private corporation. What typically happens instead is that the country, with the IMF, let me just quickly mention this. Here it is. When a corporation defaults, the assets can be sold and used to pay the bondholders through a bankruptcy proceeding. With a sovereign government, the investors will negotiate with it to obtain the most possible favorable repayment terms. But often, and of course, in both cases, the losses to bondholders are a very substantial percent of the original investment. But what I was going to say here is that with a sovereign government, often when a sovereign government defaults, the IMF, International Monetary Fund, can provide funding to ensure that the bondholders get some of their money. And then the terms of the bonds can be renegotiated with the bondholders. And this often involves a longer repayment period and or lower interest payments. In other words, the government, gets together. The Argentina would have gotten together with the IMF and said, "Listen, everyone, if you could give us 10 more years, let's say, to pay these debts, and let us pay 6% instead of 8%, we can get you most of your money back." And then the bondholders have to say yes or no. Do we take this offer or not? Knowing that if they say no, they're probably not going to get any of their money back. So it's not exactly the same thing. Argentina can't disappear by declaring bankruptcy. So I think there might have been one or two other cases fairly recently. In fact, I think Argentina might have defaulted a second time within the last few years. Let's just quickly double check this. Oh, the U.S. state. Oh, look at that. The most recent U.S. state to default was Arkansas in 1933. It hasn't happened since then. Oh, here it is. Greece defaulted in 2015. They owed money to the IMF and they couldn't pay it. That's because they had previously been running into so much trouble that they had to borrow from the IMF. And of course, that means you have to pay them back, and they couldn't do it. Wow. Yeah, that's when they were talking about maybe withdrawing from the Eurozone. And it was really quite controversial. In fact, ultimately, Germany had to bail them out. And now, so what happens is, as soon as this all this is over, the next Greek government that comes in announces that they're not going to pay the Germans back. How do you like that for gratitude? On the grounds that, they were taken advantage of, don't you see? So it's like, well, you're the ones who ran up all those debts. Maybe you're the ones who are at fault here, but all right. Anyway, liquidity, of course, is the ability to convert an asset into cash with a minimum of time and expense. U.S. Treasuries are very liquid. In fact, they're more liquid than any other bonds in the economy. The volume of trading is beyond massive. If you wanted to sell a treasury in a hurry, you could do it with no time at all. And the costs are very low. In fact, it's gotten to the point where you can set up an account with the Treasury Department and you can buy or sell treasuries directly on the internet. You don't even have to find a broker or anything like that. You can do it directly. In fact, somewhere along here, they actually encourage you to do that. They're basically saying, please, please, please buy our bonds. We'll make it easy for you. In fact, I think you can now buy treasuries in increments of $100. It used to be at least 1,000, and in fact, it previously had been a lot higher than that. There was a time when treasury bills had a minimum investment of something like $1 million. It was something really high. Now it's like, forget it. You can buy any of these with as little as $100 at a time because they want you to lend them the money. They need it. All right. Corporate bonds, on the other hand, typically tend to be very illiquid. Most investors, once they buy a corporate bond, they don't tend to trade them like stocks. They tend to hang on to them for many, many years. So they're not very liquid at all. So the more liquid a security is, the higher will be its price, but therefore the lower will be its yield. Okay, so another reason why treasuries pay such low rates is because of their liquidity. All right, it's easy to get into and out of this market. All right, tax treatment. Some bonds provide more favorable tax treatment than others. Municipal bonds actually can provide us with some very lucrative tax benefits. For example, if you live and work in New York City and you buy a bond issued by the city of New York, you will not have to pay federal taxes, state taxes, or city taxes on your interest. Okay, the point of it is they're trying not to scare you off. They want to make it attractive to you to buy their bonds. They need the money. Okay, now municipal bonds are usually used to finance local projects like fixing the roads, building bridges, you know, paying, lending money to schools to build a library, things like that. Local projects. Okay, the federal government is doing something completely different. So anyway, so there's several theories that have been proposed to help explain all those different shapes of the yield curve that we've been looking at. Nobody knows if any of these theories are actually true, but they're interesting ways of looking at it. Okay. So we start, well, there's three of them: the pure expectations theory, the liquidity premium theory, and the market segmentation theory. They all have their own way of explaining how and why the curves have the shapes that they do. So according to pure expectations theory, long-term rates are an average of investors' expected future short-term rates of interest. In other words, if we expect rates to rise, the yield curve will slope up further because this will push long-term rates up. Okay, if the yield curve is downward sloping, it means that investors expect short-term rates to drop in the future. And if the curve is flat, this means that we expect short-term rates to be more or less unchanged in the future. Okay, so again, this is a theory. Nobody's ever been able to prove that this is true or not true, but it's an interesting way of looking at the yield curve. Okay, now there's an assumption, a key assumption going on here, that investors are only looking to maximize the returns from owning bonds. They don't really care what maturities they're buying. So here's what I mean by that. And of course, the word indifferent means you don't care one way or the other. It's like if you go to the bank, I don't know if you've ever seen this now, the ATMs, at least at Chase, let's say you're asking the bank to give you $100. It used to be that they would give you whatever change, whatever bills they had in the machine. Now they're getting a little sophisticated here. You can say, listen, I need $100, but I don't want all 20s. And you can actually ask it for a specific mixture of 20s and 20s and 5s. They don't tend to carry 10s for some reason. It's usually 20s and 5s. Now, you in principle should be indifferent between getting 5 20s and 25s or anything in between. I don't know. Maybe there's some reason why you want one or the other, but of course they're both worth $100. So the word indifferent means that you're getting the same return, so you shouldn't really care which form it takes. Now, here's an example. What if an investor wants to save for 5 years by buying a bond? He could certainly buy a 5-year bond. But what if he could earn more interest by buying a 10-year bond today and then simply selling it after 5 years? Or he could buy a 30-year bond and sell it after 5 years. In our theory here, it wouldn't make the slightest bit of difference to the investor which one he does. The one that he would decide to go with would be the one that provides the highest rate of return. That's it. That's all he cares about. Is that true or not? Probably not. There's probably some preferences. People may be more comfortable with some horizons than others, but we're assuming that that's not happening here. So let's look at this theory. Suppose that the current 1-year rate is 9% and the current 2-year rate is 10%. That, according to this theory, tells us that investors believe that rates are heading up next year. Now, we can show this numerically. So now all of a sudden we have some math to do here. Well, let's say we have a couple of strategies that we can use to invest for 1 year. Or sorry, 2 years. We're investing for 2 years. We can buy a 2-year bond, or we can buy a 1-year bond, and then when it matures in a year, use the money to start up another 1-year bond. In principle, those should give us the same returns. All right, now, if you buy the 2-year bond, now remember, we said here that the 2-year bond is paying 10%, which means after 2 years, you should have earned a total of 21%. All right. What, on the other hand, would happen if I buy the 1-year bond at 9%, and when the year is up, I buy a new bond? Well, all this algebra, let me just skip it to the chase, tells me that in order to achieve the same return, which is a 10% return for 2 years, by buying a 1-year bond, with a return of 9%, I must earn 11% during the second year. So let's prove that real fast. Let's just say that I've got $1,000 to invest. Yeah, let's do some math here. We haven't done a lot of math. All right. So in other words, we start with $1,000. And we invested for 2 years at 10%. Actually, let me draw this a little bit differently. Assume we want to invest $1,000 for 2 years. In the first case, we buy a 2-year bond paying 10%. All right, so we'll use a timeline. These numbers represent years. This is today. This is 1 year in the future. And this is 2 years in the future. Now I'm earning 2% each year for 2 years. So that means at the end of year 1, I'll have 1,000 times 1 plus that 10%, or $1,100. At the end of 2 years, my $1,100 in year 1 is invested at 10%. And that means at the end of year 2, I've got $1,210. Now, suppose I try the second strategy. I'm going to buy the 1-year bond, which pays 9%. All right, so let's do that. Buy a 1-year bond paying 9%. And then reinvest in another 1-year bond. Okay, so how does that look? So remember, the 1-year return is 9%. Now, here's the interesting part. We do not know today what the 1-year rate will be in 1 year. In order for us to be indifferent between these two strategies, we need to make sure that in year 2, we end up with 1210. So that means this 1,090 is invested for 1 year at rate X. And so 1090 times 1 plus X equals 1210. Okay. Whoops, hold on. So subtract 1090 from both sides to get 120. Therefore, X equals 120 over 1090. And that turns out to be almost exactly 11%. Okay, now what does all of this prove? This shows that if we look in the market and we see that the 1-year rate is 9% and the 2-year rate is 10%, the only way this can work or make sense or be consistent is if investors expect 1-year rate to be 11% next year, so that the two strategies, or they are indifferent between the two strategies that we used. If the only way we can stay indifferent, if we think that next year the rate will be different than 11, then one strategy will become more attractive than the other. Now, this is where it gets interesting. If investors do not expect the 1-year rate to be 11% in 1 year, they will not be indifferent between the two strategies. They will therefore engage in one strategy. Well, let's just say their trading activity will shift the returns to the 1 and 2 year bonds until the investors are indifferent once again between the two strategies, which means buying a 2-year bond or buying a 1-year bond and reinvesting the proceeds in a new 1-year bond. All right, so it's the fact that we think that next year we'll have an 11% rate, which prevents us from all engaging one strategy or the other, okay? Because if that happened, then rates would adjust until, once again, we're indifferent between the two strategies. And you would expect that to happen fairly quickly. So, this seems like a reasonably good theory. the issue that people have with it is this idea that they're indifferent between different horizons. And, people, a lot of economists feel that people are more likely to have certain preferred maturities that they tend to stick with. And so that would tend to throw a monkey wrench into these calculations. But in general, I think everyone can agree that if we expect rates to head up, there's still a tendency for longer term rates to go up compared to shorter term rates. Now, in this opposite case, instead of 9 and 10, we have 8 and 9, 9 and 8. In other words, the 1-year rate is 9, the 2-year rate is only 8. So let's just quickly run through it and see what that implies about next year's 1-year rate. And we'll skip over the algebra, and you'll see that it's 7. So because the 1-year rate is higher than the 2-year rate, this implies that investors are looking forward and seeing a lower 1-year rate next year, specifically 7%. All right. So, and this simply means that investors will be indifferent between investing for 8% for 2 years or 9% for the first year and 7% for the second year. In other words, the fact that rates are falling or we have a downward sloping yield curve means that investors are looking ahead and seeing lower rates in the future. All right, so that, in other words, that would be this case. The one that we don't see very often in practice. Whereas up here, it's the other way around. Okay. Now, the liquidity premium theory is a little bit different because here we assume that investors require compensation for holding longer term bonds. They're no longer indifferent between short-term and long-term bonds. In order to buy longer term bonds, they require a higher rate of return, and that additional return is called a liquidity premium. All right. Now, maybe this is true, maybe it's not. Again, these theories, I don't know if it's possible to really test these. So what this does is if this is really true, then the curve will be steeper. Let's just say this is the curve under expectations or pure expectations. With liquidity premium theory, the curve would be a little bit steeper because investors expect to be compensated for holding these long-term bonds. All right, so again, we can do a little algebra. So what we've done here is we don't want this to get too messy, but we just want to get the idea. We've got 5 consecutive 1-year rates, and we've got liquidity premia for each of these rates. And so let's see, what are we trying to figure out? Oh, the implied 2- and 5-year rates. All right, so I don't want to dwell too much on the algebra, but I do want to show you that in the 2-year horizon, with the expectations theory, the 2-year rate is 5.5%, whereas with liquidity premium theory, it's 5.623%. With 5 years, the expectations theory gives us 6.99%, and liquidity premium brings it all the way up to 7.49. And then finally, we have one more. The market segmentation theory tells us that investors have very definite preferences for certain maturities. And so the rates or yields within each maturity range are determined by supply and demand conditions in those markets. For example, 30-year rates are influenced by the supply and demand for mortgages, whereas the short end of the yield curve would be influenced by other considerations. So what that means then is that investors require a risk premium to move outside of their preferred maturities. And so therefore, the premiums that are embedded in the yield curve, let me just mention this, unlike the liquidity premium theory, where the premia are directly related to maturity, with the market segmentation theory, there's no particular pattern to the premia required by investors to move outside their preferred maturity range. So the yield curve can then have any shape. Whereas with the first two theories, there's a tendency for it to be a nice, smooth rising curve or falling curve. Here, you can see strange things going on, like, for example, the bumpy one that I showed you earlier would not really make sense with expectations or the liquidity premium theory, but it certainly is not a problem with the maturity preferred the market segmentation theory, because it may just be that there's a strong preference for these bonds versus these bonds. And that would be the explanation for why yields are higher in this tiny little range than they are over here. All right, so that's enough of that. So we're going to move into chapter 4 now. And we're going to switch topics. Now we're thinking in terms of the Federal Reserve System, which ultimately determines the interest rates in the economy. But before we do that, we're going to look at a really fun topic. And I mean fun, fun, fun. And that topic, as you can probably guess, well, let's see what it is money. All right. Yes, we're going to look at money. We're going to take a close look at it. Now, of course, everybody thinks that money means those little green pieces of paper in our wallets. Well, that's an example of money, but money is a much more general concept than just that. And throughout history, there have been many, many different kinds of money circulating, not just in the United States, but throughout the rest of the world. Now, the reason why we have to talk about this now is because the Federal Reserve doesn't directly set rates of interest. It can only influence them through its control of what we call the money supply. So that's why we start this discussion with a look at money. And then we'll also mention the banking system because they're heavily involved in this process. And then we'll look at the Fed itself. All right. Now, what is money? An economist would say that money is any asset that satisfies the following functions. It must act as a medium of exchange. We'll see what these mean in a minute. It must act as a store of value and a unit of account. Anything that actually satisfies these three functions could be considered a form of money. Now, I'm sure you're aware of the fact that in recent history, even in the US, gold circulated as a form of money. Not anymore. Now we just use paper money. So, and prior to that, there were other types of monies. Right now, most countries just use paper money. And there are good reasons for doing that, and there are bad reasons for doing that. So what we want to do is analyze each of these functions more closely, which will help us understand types of money that have circulated in the past throughout the world. In fact, I have a short presentation that I want to give you about different forms of money that have been used throughout the world. So what exactly is a medium of exchange? Well, it is something that has to be easily standardized. Now, this is why gold and silver were so popular, because gold could be easily turned into coins. That's a huge step forward. When prior to the creation of coins, in order to spend gold, every time you took out a piece of gold out of your pocket and used it to buy something, the seller had to take out a little scale and weigh it, and then also assay it for its purity to determine how much it was really worth. Now, as you can imagine, that was horribly inefficient. So it was replaced eventually with coins, where you can just look at it and see, oh yes, this is a coin issued by the King of England. It has a certain amount of value. I can accept it without having to weigh it every time. So gold and silver were very well adaptable to coins, which is one reason why they're so popular as a form of money. Universally acceptable. Everybody has to take it, otherwise it doesn't work. That gold and silver, that was never a problem. Everybody recognized that gold and silver had a value that they could count on, and so they would be willing to sell you merchandise in exchange for gold and silver. And then finally, whatever you're using as a form of money should be divisible into smaller units to make change. Now, that seems like a common sense idea, but here's an interesting historical footnote that you might find interesting. During the colonial days, the US government faced a severe shortage of silver to make coins. So what did they do? Well, at this point in time, a lot of foreign coins were circulating in the United States. In particular, Spanish silver coins, Spanish silver dollars, were floating around being used as money because everybody recognized that they had a significant amount of silver content. But without having a lot of change floating around, what would you do if you took your dollar into a store and tried to buy something that was only worth 50 cents? What are they supposed to say to you? No, we don't have any change, get lost. So they came up with this very clever solution. First of all, let me show you the coins that I'm referring to. This is the Spanish silver dollar, and it contained quite a bit of silver. These are really nice coins. They're worth quite a bit of money at this point in time. I mean, this is 1733. Can you imagine what these could have bought? So what did they come up with? What was this clever solution? Let me show you. What's going on here? The store owners would take out, I guess, a knife or an axe, and they would cut the coins into smaller pieces and give you back your change. And you can see they could be cut up into as many as 8 pieces. And in fact, this is where they got the name pieces of 8. You probably heard that word in every pirate movie you've ever seen in your life, pieces of 8. These are Spanish silver dollars that could be cut up into as many as 8 pieces to make change. That's the idea they came up with. So because of this, prices tended to be quoted in eighths of a silver dollar. You go in the store and the sign would say, this costs 3/8. They were actually called bits at that point in time. So the price would read 3 bits, meaning 3 of these pieces of the coin. And in fact, when we finally got on our feet and had enough money or coins to produce metal to produce our own coins, this is one of the reasons why we have quarters, because it made sense. People were used to thinking in terms of eighths. 2 of these eighths are a quarter. So that's why we have quarters. If you ever noticed, many countries do not have a 25-cent piece. They have 20, they have 50, they have 10. They do not have 25-cent coins. For example, in England, they do not have a 25-cent pence coin. And in the Eurozone, they do not have a 25 euro coin. It's 20 and 50, and there's nothing in between. That's because they don't have this history. So for us, having used these bits for all those years, it made sense that a single coin should be worth 2 bits or 25 cents. In fact, no, Canada has quarters, but if you go to, let's say, England, let's say if I wanted to look at a picture of They have, here they are. The coins are 1 pence, 2 pence, 5, 10, 20, 50, 1 pound, and 2 pounds. How about euros? All right, they've got pictures here, but look at that. 1, 2, 5, 10, 20, 50, 1 and 2. Just like England. Where's the quarter? It doesn't exist. They don't have one. How do you like that? And in fact, for many years, until surprisingly recently, stock prices were quoted as fractions. And this is the reason why. Because in the early days, prices were quoted in terms of bits. Okay, so stock price might be 10 and 3/8, meaning $10 and 3 bits. That's okay. Now, these Spanish coins were continued to circulate in the United States until 1857. Then they were no longer considered to be legal tender. Now, of course, it turns out that during the Civil War, we also had a severe silver shortage. And so what they did then was not use fractional coins. They created paper money, which had fractional values. In other words, you could have a piece of paper in your wallet that was only worth 25 cents or 10 cents or whatever the case may be. Again, because of the lack of metals to make coins. So this business about being divisible is pretty important, don't you think? Yes, it is. You see what lengths people had to go through when it wasn't possible to do this. All right. What other properties should a medium of exchange have? It should be easy to carry it around. All right. So in other words, you probably wouldn't use baseballs as a form of money. I don't think they'd fit in your pocket, would they? And durable. Ideally, a form of money should be durable, should not deteriorate quickly. Now, there have been times when that wasn't true. Again, during the colonial days, when we had such a severe shortage of silver to make coins out of, in Virginia and in Maryland, for a brief period of time, tobacco leaves were circulated as a form of money because they were tobacco growing states. What's the problem with tobacco leaves? Well, they don't last forever. They rot away eventually. So that didn't work out too well. Now, here's another interesting historical example of a type of money which is extremely durable, but it's not easy to carry. So let me show you a picture of it. So this is an island in the South Pacific called Yap. And on the island of Yap, these enormous stone wheels act as a form of money. Now, you might say, how can such a thing be? You certainly can't move them. No, you can't. It doesn't matter because everybody in the island has a record of who owns which stone. And that's how they carry out their transactions. They change the numbers in their little books so that everybody knows which stone belongs to whom. And so the stone can stay there forever. It can change hands. The ownership can change hands, but the physical location never has to move. Okay. Everybody knows that that rock that this guy's standing next to belongs to Joe Smith. So there's no point in stealing it, even if you could. I saw a documentary about Yap once. If you walk around on the island, you can see there's these little clearings in the forest where all these stones are just sitting there. There's no need to move them because everybody knows where they are and what they're worth. How do you like that? Now, this hole in the middle is there, so if they do need to move it, they can put a log through there and roll it to someplace. But anyway, at some point, though, in '86, Yap did officially adopt the U.S. dollar as its currency. So therefore, even though the stones continue to be used as a form of money, people also use U.S. dollars. All right, so those were the 4 basic properties of a medium of exchange. So Every time you run across a new form of money, you can ask yourself, does it act as a medium of exchange? Does it satisfy all these requirements? If so, it might be a good candidate for a form of money. Now, how about store of value? What properties do we need for a store of value? Okay, basically this comes down to something that maintains its purchasing power, unlike tobacco leaves. It makes saving possible, and it provides liquidity. That's what it means to be a store of value. And of course, we know what liquidity is. It's the ease with which an asset can be exchanged for goods and services. All right, so this is ideally what your money should be, liquid as possible. Now, here I've made up a short list of assets according to their liquidities. So you can see that in the highly liquid column, we have currency, which of course means paper money and coins, checking deposits, and finally savings deposits. Is it easy to convert these into goods and services? Yes. Over here in the middle column, we have stocks and bonds, which, they're not quite as liquid as checking deposits. I can pay for things directly with a check. But if I can't buy things with a stock certificate, can I? No. I have to go through the trouble and expense of selling it first. So they're liquid, but just not quite as liquid. And then CDs are bank deposits where you must leave the money on deposit for a specified length of time, like 1 year, for example. So obviously these are not as liquid as traditional savings deposits. And then finally, in the last column, we have the illiquid assets that are hard to sell and expensive to do so: real estate, art, precious stones. Now, what's important about these assets, though, is that the highly liquid assets also provide the lowest rate of return. The illiquid ones tend to return the highest rate of return. So most investors own some of each. All right. You don't want to put all of your wealth in the form of cash, that's for sure. But you don't want it all in the form of art either, because what happens if you have an emergency and you have to have your roof fixed? You can't pay for it with paintings, can you? All right. So liquidity is the third and one of the more important properties of a store of value. And then finally, we have the unit of account, whose only purpose is to provide us with prices. So imagine what you would do without prices. Let's say you went to the supermarket and said, I need lettuce. I'm a software developer. Could I trade a software program to the store for lettuce? Probably not. So when we had no money, or when there's no money in circulation, goods and services have to be traded directly back and forth for each other. And we call this process barter. And barter is a horribly inefficient system. So in fact, money was invented to avoid the need for barter. All right, now, before we go any further, I have a fun little presentation here that I'd like you to see. I just briefly put together some interesting historical examples of assets that have acted as forms of money throughout history, including the United States. So let's take a quick look at that. And then we'll get back to this, don't worry. All right, so these are unusual forms of money that have circulated throughout history. So I'll start by saying that humanity has used many forms of money over the years. Some of the strangest ones are in my presentation. So first, let's take a quick peek at some pictures of them. Well, there's the stone money of Yap up here in the upper right-hand corner. These beads are called wampum. They're made by American Indians. And these belts of beads have been used as money. We have shells down here. And then we have cigarettes. Now, apparently during World War II, unopened packs of cigarettes were traded among the soldiers as a form of money. And supposedly this happens in prisons as well. Here's some actual coins and notes. These are all, of course, Euro notes. These two, I believe, they might be Roman coins. They might be Greek. I'm not sure. And then over here we have a coin from the country Ghana, which has the seashell on the front. All right, now let's start with this one. Now, shell money, or these are called cowrie shells. They have been used as a form of money in Asia, Africa, Australia throughout the 19th century, as well as China and India. Now, of course, the problem with a form of money like this is that the supply, well, the government can't really control the supply of money, of these shells. People find them, and all of a sudden, the money supply expands. So you could have a lot of inflation if people keep finding more shells. Not only that, but I don't know how hard they are, but they probably are breakable. So this is not ideal. And I don't imagine it's easy to make change either. Now, how about this one? Although it's hard to see it from there, these are bricks of tea that were squeezed together with a design on the top. And these are used as a form of money in countries like China, Tibet, Mongolia, and Central Asia throughout the 19th century. Now, I don't know how hard they squeeze these, but I can imagine that they break very easily. So I wouldn't think this is a very successful form of money. but they tried. Now, this is a weird one, bottle caps. For a brief period of time in Cameroon, bottle caps were used as a form of money. They must have been really desperately short for silver and gold to let these be used as coins, but that's exactly what they did. Okay. Now, on the other hand, here's something cool. These are actual coins used in the country of Somalia. They're little guitar coins. Now, that's the coolest form of money I've ever seen. But don't be deceived. These are actually not meant for general circulation. These are meant to be commemorative coins. Although they're technically legal tender, they're not actually used as a form of money. We have the same thing here. There's all kinds of commemorative coins that were never meant to be spent in public. If you go to the San Francisco Mint, they have all kinds of coins that were not meant to be sold to the general or circulated. You can see they can put anything they want in here. And it might say the word $1 on it or $5, but nobody in the right mind would ever spend them because they're worth so much more than that as collector's items. So yes, look at these. These are made of platinum. Ooh. Yeah, that's why these prices are pretty high here. Wow. But anyway, religious coins, that is a little vial of holy water from Lourdes. Okay, this is a silver coin with holy water mixed in, and this was circulated in the country of Palau, an island in the Pacific Ocean, in 2007. Whatever goes, now look at these squirrel pelts. Now, clearly, this is a very cold country where they're using squirrel pelts as a form of money. That country turns out to be Russia, because they were hard to trap them, hard to clean them, hard to do all the rest of the work. This is not an easy process, so they came to be formed or to be used as a form of money. How about this? Wooden money. Now, this is a country that's running short on everything. There's no coins, there's no metal, there's no paper for paper money. This is literally a piece of wood. And this was issued, as you can probably guess, in Germany right after World War I when they experienced hyperinflation. So they had to do this because that's all they had available to them. Kissy coins, these are circulated in Africa, Western Africa. They're iron rods. People had to be careful with them because if the end snapped off, they would lose a lot of their value. And of course, you can see they can't be that easy to carry around. The quarter tara. Now, look at that coin. What problem do you suppose this one represented? It's easy to lose it. Crazy easy. So this circulated in India from about the 14th to the 16th century. It is the smallest known coin in history. How do you like that? Salt. Oh my God, salt, could that actually be a form of money? Well, yes, it was during the Roman Empire. Salt was very hard to find in those days, and it was valuable because it could be used to preserve foods when there was no refrigeration. And in fact, it was so valuable that the Roman soldiers were paid in the form of salt rather than money. And in fact, here's a fun fact. The word salary is derived from the Latin word for salt. Oh my God. How do you like that? Because that's how they were paid. It was more valuable than the Roman coins. So the soldiers were happy to have the salt instead of the coins. Oh, you never know. Yeah, throughout much of history, spices have been unbelievably expensive. During the 15th, 16th, 17th centuries, pepper was worth more than gold. I mean, that shows you how valuable it really was. Here we go. Well, we're already familiar. Here's our old friend, the stone money of Yap. They're pretty cool looking, aren't they? And they just sit there and nobody bothers them. And everybody knows that's Bob's stone and that's Jane's stone, and nobody ever touches them. There's no such thing as stealing because everybody would know right away that you stole somebody's stone. So they just leave them out there. Now, let's get to the US. The US has had its own interesting forms of currency, most of which you've probably never seen before. For example, here's a trivia question that I'm going to pose to you before we get started. So far, only one woman has ever appeared on US notes, meaning paper money. Who is she? Now, there have been women on coins, but only once on paper money. You might recall a while back we had Susan B. Anthony and we had Sacagawea, but those were coins. Oh, so we'll have to mull over that one. Okay. So now here's a note that was issued in 1777, possibly printed by Ben Franklin. And it's really very childish looking. Looks like, today somebody could print that off in their backyard or their basement. The problem in those days was counterfeiting. And in fact, it was such a problem. If you look at this carefully, you'll see the motto here is "to counterfeit is death." It literally was, counterfeiting literally carried the death penalty. That's how serious a problem it was. But that's the best we could do. Remember, there's no coins. There's not enough silver floating around. The British actually made it illegal to export silver to the United States after we won our independence. They didn't want it to make things easy for us. So now, luckily, now things calmed down a little. Eventually, that slogan was replaced with in God we trust. Sounds a little nicer than to counterfeit is death. Imagine if it still said that on our coins. To counterfeit is death. That would be kind of gruesome. Okay. Now, be prepared for the shock of your life when you see the size of this note. All right. Is it a good time of night to be shocked? All right. Well, let's be shocked. It's a fun kind of shock. What do you see there in front of you? This note was worth $100,000 in 1934. And not only that, but it's a gold certificate, which means anytime you felt the need, you could take it to any bank and they would have to give you $100,000 worth of gold. This is when we were still in the gold standard. And it even says on the top here, this is to certify that there is on deposit at the Treasury $100,000 worth of gold, meaning that they're guaranteeing that you can have gold anytime you want if you don't trust paper money. So you can imagine that's the largest note that the US government has ever issued. Can you imagine what it would be worth now? Sometimes these, you never know what you can find on Google. Let me just see if I can find this. What is the current value of $1 in 1934? 2009. Okay, so that means that bill is worth about $2 million. Oh my God, it's equivalent to a $2 million bill today. Of course, Jeff Bezos probably would have those in his wallet all over. He'd walk around town with those in his wallet, but still, that's a lot of money. Now we're going to come up. Oh, here we go. Already the answer to the trivia question is about to make itself known to you. Are we ready? Let's see if we guess the woman who appeared on paper money in the US. Now, this is around the time of the Civil War. Here we go. Who is that lady? Well, it's Martha Washington. That's right. Martha got to be on the $1 bill during the Civil War. It's a $1 silver. It's a silver certificate, meaning like what before, I could take this to any bank and they would be forced to give me $1 worth of silver. Now, this is the 1860s, I believe. It's worth a lot of money. In fact, let's do this. Oh, here we go. According to this, that would have bought the equivalent of about $20,000 today. Ooh, that's a lot of money. Now, this is the other extreme. I mentioned this earlier. This note is worth 3 cents. It's a piece of paper just like a dollar bill, except that it's only worth 3 cents. And again, because during the Civil War, we didn't have enough metal to produce coins. And so guess what? This is how they got around it, by producing notes. Now, by this point in time, counterfeiting is less of a problem, but still, I'm sure it made the government nervous. These notes were available with amounts ranging from about 3 cents to about 50 cents. Now, we're going to look at some coins. The largest denomination coin ever produced in the US is about to show up in front of you. All right. The largest coin we ever had was worth $20. This is the very turn of the 20th century, 1903. It's a double eagle, it's called, worth $20. There was an eagle worth $10. There was a half an eagle worth $5 and a quarter eagle worth $2.50. And so this was the biggest of them all. Now, these coins are very valuable today. In fact, if you wanted to buy your own, what do you suppose it would cost you? A collector would pay, that's 1927. Oh, it's only $2,100. That surprises me a little bit. I thought it would be more than that. But it's a nice coin, isn't it? And then here's the $5 coin. Oh, you can have that for as little as 608.21. This is the $5 Indian head gold coin. And that can look at how cheap that one is, 729. And let's see, what else do we have here? There might be quarter eagles. This is a quarter eagle. Yes. 250 worth of gold. The gold content is 250 at that time. Wow. Anyway, so now we're going to see the other extreme, the smallest US coin ever minted. We go from one extreme to the other, and this is worth half a cent. Now, I checked this out before. I came up with a calculation that this coin was worth the equivalent of about 15 cents in today's money. So it's not an absurdly small coin, but this is the smallest one we've ever had. 1847. I don't know when they withdrew them from circulation. Okay, so yes, the US coins and notes have had a very interesting history. In fact, let me just see if I can find this. Here we go. Now, there's an interesting scandal that took place in our history with coins. Look at this coin. Now, this is 1883. This is a nickel coin. Now, it's got Liberty on the front. It has a big V in the back, Roman numeral 5. Here's the problem, though. No place on this coin does it actually say the words 5 cents. Now, it was made out of nickel. So crooks had these gold plated and tried to pass them off as $5 coins. And it worked to a certain degree, and they came to be known as racketeer nickels. Then, of course, the next year, I mean, they were all withdrawn from circulation, and the next year they came out with the words, oh, this one doesn't have it either, 5 cents, so that would never happen again. But for that 1 year, that must have been driving everyone crazy. These racketeer nickels, people were being cheated right and left because the coins didn't say the word 5 cents. Oh, now that's a pretty big screw up. So they forever came to be known as racketeer nickels. Yep, not a mention there of the set. And then the next year they brought it out, and the word cents was sneaked in here somewhere. I thought you'd find that amusing. You'll tell all your coworkers at work tomorrow, I bet, about the racketeer nickel. So anyway, so that's our brief detour into the history of U.S. money. So when we come back to our notes, I'll show you one other more interesting thing, and then we can dive into the money supply itself, which is what the Federal Reserve actually controls. But in the meantime, I'm sure we can all agree that it's plenty of time to have us some coffee. So we'll have our break right now. When we get back, we'll dive into the measurement of the money supply. Okay, and then we'll eventually get to the role of the Fed. All right, so we'll be back in a bit, and then we'll talk about the money supply. All right, here we are. So barter, yeah. All right. Oh, here we are. Now, here's another interesting website. The Federal Reserve System, which we'll be studying in this chapter, has 12 district banks. One of which, of course, is in New York City, but there's one in San Francisco. And what's interesting about that one is that they have a museum in their building about the history of U.S. money, currency, and notes and coins. And so they've been very nice to put pictures of some of these historical notes and coins on this website, so you can look at them even if you're not in San Francisco. So this is the link. And I just want to briefly show you that there's quite a few nice examples here that you can look at as, when you have time. But there's a few that I wanted you to see in particular. Like, for example, we have gold certificates, some of which we saw earlier tonight. Let's say, for example, this one. This is a $1,000 gold certificate that was issued in 1907. And you could trade this for $1,000 worth of gold anytime you chose to do so. And wow, this one is worth $5,000 in 1907. You can imagine what that would have been worth today. So there were quite a few nice examples here. What else do they have? They have quite a few. Fractional currency, we mentioned this earlier during the Civil War. For example, this one is worth 10 cents. This one is worth 10. This is 15. We have all kinds of them, 25 cents. And so again, this was during the Civil War when there simply wasn't enough metal to go around to produce coins. Any other things that are very interesting here? There's a lot. There's quite a few, but um, let's see. What else do we have here? Early banking in the United States. Now here, what you'll notice is that this one was issued by the first, it looks like it's the first bank of the United States, which we'll discuss later on. Um, this is actually the predecessor of the Federal Reserve System. And now you notice this note, Miners Bank of Savings. This is actually a savings bank, and they were allowed to issue their own notes. This one, if you notice, it's payable to the bearer on demand, 25 cents worth of gold dust. Okay, so even in those days, 25 cents wasn't going to get you a whole lot of gold. So they're promising to give you gold dust worth in exchange for this note. All right, anyway, so you get the idea. So there's our friend, the racketeer nickel. That's what it's supposed to look like. It's actually nickel, but remember, there's no 5 cents here. So crooks turn it into this, and all of a sudden, people think that it's a $5 gold coin. Well, they couldn't get away with that today because it would be on the internet in a second. But in those days, communication wasn't nearly as rapid as it is now. Now, the next thing we want to look at is the money supply. So, with all the different kinds of money, potential monies out there, um, the Federal Reserve has created several key definitions of what we mean by money. So, the number one definition of money that they typically use, which has the formal name M1, primarily consists of currency or paper money and coins, plus checking deposits. There's other items in there as well. Let's jump ahead here and look at the official definition of M1. And it consists of currency in circulation, plus checking deposits, plus traveler's checks. I don't know if you remember those or not. Apparently, they're still around. And what we call negotiable orders of withdrawal. These are essentially checking accounts that have a higher rate of interest, but where the checking privileges are very limited. All of these are collectively known as M1, and this is one of the two most important definitions of the money supply in the United States. Now, I do want to point out that recently the Fed changed these definitions, but until very recently, like even earlier this year, this is how they formally define M1. Then we have M2, which is M1 plus a few other items, savings deposits, time deposits, which means CDs, less than $100,000, and money market deposit accounts for individuals. So M2 is a broader measure of money than M1, whereas M1 is a more liquid measure than M2. Now, until they changed the definitions, you could look up how much of each was in circulation. For example, let's look at M1. Now, I know they discontinued this series, but let's see how far we can reach. Right about here, as recently as Monday, January the 18th, M1, which was still being measured, was worth $18 trillion. So that definition of the money supply was worth about $18 trillion. What about M2, which has also been changed very recently, as a matter of fact? Let's see what that was worth. That one was recently worth same day, about $19.5 trillion. So it wasn't too much higher than M1. I don't know. The Federal Reserve has its own literature about what happened to M1 and M2. Let's see if we can find something. Hmm. I'm just seeing if I can find an article that explains what they did. Well, all right, I'll find it. But I know that this happened very recently. All right. So now we also have the monetary base. Now, the monetary base is under the direct control of the Fed. And we'll see more about this later on. But it consists of total reserves. Now, reserves are deposits held by the banks with the Fed, and C is currency in circulation. These two collectively form the monetary base, which we'll see as we go along, is under the direct control of the Fed. So now we're ready to start looking at the Fed itself. The Federal Reserve System is the central bank of the United States. It was created in 1913. It had two predecessors. The First Bank of the United States, which lasted from 1791 to 1811, and then, of course, the Second Bank of the United States, which lasted from 1816 to 1836. So Alexander Hamilton was heavily involved in the creation of the First Bank of the United States. He felt that we needed to have a strong central bank if we were ever to grow to be a modern country. He didn't want us to stay a small agricultural country. He wanted us to grow and become a dominant world player, and that meant having a central bank. So Congress granted it a charter that lasted 20 years, and then it wasn't renewed for some reason in 1811. 5 years later, the Second Bank of the United States was created, again with a 20-year charter that ran through 1836. Now, this time, the key cause of the lack of a renewal was the vehement opposition of President Andrew Jackson. He hated banks. He didn't want the country to be under the control of bankers, so he did everything he could to make sure that the second bank was not renewed. So it wasn't, and then we didn't have a central bank again until 1913 when the Fed was created. So as you can probably imagine, the economy was pretty chaotic during those years without a central bank. Not only was there no central bank, but during that time, the individual states were allowed to print their own money, and individual banks were allowed to print their own money. So there were many kinds of money circulating, and there was no central bank. So the economy went through many boom and bust cycles. There were several recessions and one major depression during this period. And so finally, in 1913, the new Fed was created in recognition of the need to have a central bank, because now we're moving out of the, let's face it, the 1800s, the economy was still largely rural and agricultural. In the beginning of the 1900s, the U.S. economy is moving into a more modern state, leading up, of course, to the World War I. But it was pretty clear that there needed to be a central bank to deal with any crisis that might come along, and to also oversee the banking system, and to also conduct monetary policy. Anyway, what are the Fed's objectives? To regulate the banking system, act as a lender of last resort, meaning that they'll bail out banks that are in trouble. They'll issue currency. They're, in fact, the ones who issue all the paper money in your wallet. It was issued by the Federal Reserve System, although it was actually printed most likely at the Bureau of Engraving and Printing in Washington. And of course, most importantly, they conduct what we will call monetary policy. Now, the Fed itself, as I mentioned before, is broken up into 12 district banks. And you can see by this map, they're scattered around the country. One is in New York, Boston, Philadelphia. The Board of Governors in Washington actually controls the whole system. And as we get further west, you notice that there seem to be a little more spread out. Why is this happening? Because this is 1913. The population on the West Coast was very, very sparse. So each of these districts is supposed to represent the same population. That's why they're sort of clustered in the Northeast, and they're more spread out as we get further west. You can see the San Francisco Fed covers, they include Alaska and Hawaii. That's 1, 2, 3, 4, 5, 6, 7, 9 states. Wow, that's a lot. Look at the Minneapolis district. They've got these enormous states with hardly anybody living there. So there's 12 altogether. And the purpose of doing this was they wanted to make sure that the central bank of the United States, or the Federal Reserve System, didn't become too powerful. It was structured to be an independent entity. It is highly independent from the federal government. And in fact, it does not get a budget from the government because it has its own sources of income. So it really does stand alone from the rest of the government. So that gives them the freedom to carry out their duties as they see fit without a lot of political pressure. The overall system is overseen in Washington by the so-called Board of Governors, which has 7 members, including the chairman and the vice chairman. Each governor is appointed to a 14-year term by the president. It's not exactly lifetime like the Supreme Court, but that's still long enough to hopefully insulate the members from political pressures. The chairman and the vice chairman are appointed to a 4-year term by the president. Okay, now, if you're not sure, currently the chairman of the Fed is Jerome Powell. He was appointed by President Trump a few years ago, and he's been in office ever since. He is actually in charge of the entire Federal Reserve System. All right, basically he's the boss. All right, so he's in charge at the moment, and the Board of Governors has several responsibilities. We'll see what these mean in a little while. The required reserve ratio refers to what proportion of a bank's deposits have to be held in account with the Fed. And the discount rate is the rate of interest that the Fed charges the banks for loans. The governors also oversee the entire banking system. Now, interestingly enough, unlike most countries, in the US, banks are regulated at the federal level by the Fed, but also at the state level. So every bank is subject to both federal and state banking regulations. So it's a very complex system. Now, probably the most important component of the Fed is the so-called Federal Open Market Committee, which carries out monetary policy. Now, this is a fairly complex discussion, so I think we should probably cut it off right here and save this for next time so we can go through it properly and really understand what the Fed is actually doing. So in the meantime, I guess we'll stop right here, and then we'll carry on with this discussion next time. We'll be looking at the structure of the Fed, and we'll take a more intense look at monetary policy and how it affects interest rates in the US economy. Okay, so that's where we're going next time. All right, in the meantime, don't forget the San Francisco Fed website is right here. So let's say you've got nothing to do at work tomorrow and nobody's looking. You might want to take a peek at this website when nobody's looking, and you'll get to see all these cool forms of notes and coins that have circulated in the United States. It's a lot of fun. All right, so I guess I'll see you all next time then. All right, good night.
Good night.
Thank you. Good night.
Bye.